The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone, and welcome to first EVPA webinar of the year, Key Trends and Results on European Investors for Impact, the EVPA Survey 2017-2018. It's a pleasure for me to welcome all of you to this session today. My name is Gianluca, and I'm Research Associate at the European Venture Philanthropy Association, where last year I was in charge of the data collection and the data analysis for our survey. And I'm speaking to you today from our office in Brussels. Before we dive into the topic of today's webinar, I would like to address a few housekeeping rules. Throughout this session, you will be able to open or hide the control panel, which is the console that appears on the right-hand side of your screen. At the end of the webinar, we will have 15 minutes for a Q&A session, during which our panelists will answer your inquiries. If you do have a question, don't hesitate to write it down in the relative section of the control panel at any moment during the webinar. And please don't forget to clearly mention to whom you would like to address it. Since the number of participants in this webinar is very high, we are keeping everyone muted. Last but not least, note that this session is being recorded, and you should be able to watch the recording and consult this presentation as of next week on the EVPA website. If you encounter any technical issue, please don't hesitate to contact my colleague Caroline. You can find a number to reach her here on the slide or on our website. You can also use the question section to let us know about any technical problem while connected to the webinar. Now that these housekeeping details are clear, I can introduce you to my colleague Alistair Don, EVPA Research Manager, who is responsible for our research activities on best practices and the data collection, and who will be moderating this webinar with me. Then, to comment on the key results of our study, we have today 4 experts who represent the different voices in our community, ranging from grant-making foundations to social impact funds, investing in a broad range of geographies from Western to Central Eastern Europe, from Africa to Latin America. Furthermore, since this year it is the EVPA 15th anniversary and it's very important here for us, we have decided to engage 4 of the organizations that showed us great commitment throughout the years, having always responded to our industry survey. So I'm glad to introduce you to Katinka Greve-Leiner, Director of First Social Entrepreneurs since its establishment in 2009. First Social Entrepreneurs is the social investment arm of FIRD, a family-owned Norwegian investment company committed to value-creating ownership of businesses and investments in financial assets. Currently, Katinka is also board member of Den Sociale Capital Fund in Denmark. Then, welcome to Jelena Jakuli, investment manager at SA2 Fund, a Belgian social impact fund particularly keen to support early stage or growth phase businesses with scalable, innovative solutions and an integrated impact business model. Before joining SA2, Jelena was managing investments in Eastern Africa for Oiko Credit, an international impact investor. Then today we have with us Franz Kruller, Senior Advisor to the Board of Erste Foundation and to the Savings Bank Group in Austria. Erste Foundation promotes a strong and confident civil society in Central and Southeastern Europe. Before joining Erste Foundation in 2005 as Program Director for Social Affairs, Franz worked for Caritas Austria for 17 years. And last but not least, welcome to Patrice Schneider, Chief Strategy Officer at Media Development Investment Fund, MDIF, which invests in independent media around the world, providing the news, information, and debate that people need to build free and thriving societies. Patrice is also a member of EVPA. To dive into the webinar structures, this is the agenda of today. I will start presenting you the industry survey, and with the help of our speakers, I will explain its scope and objectives. After that, Alessia and I will present you the survey's result, divided in 3 parts. First, Alessia will describe our respondents using the data linked to the core practices of the venture philanthropy approach. Then I will provide you with an overview of the venture philanthropy and social investment sector. And finally, I will present you the key trends identified. During this presentation, we will interact with our speakers and they will share with us their insights about the different practices and findings. In the end, we will have 15 minutes for a Q&A section as already mentioned earlier. Let's start with the EVPA survey scope and objectives. On this slide, you can see the material we have produced thanks to the data collection. So an industry survey report and a visual infographic, which can be downloaded for free on our website. Talking about our latest industry survey, we can say it collects responses from 110 European investors for impact that invest in Europe but also worldwide. As you can see, the majority of the respondents are based in the UK, followed by Germany, France, and the Netherlands. This year's survey widened its geographical focus further, in line with the attempt to make the survey sample more representative in each edition, moving from 21 countries represented to 25, with Russia, Slovenia, Portugal, and Finland represented for the first time. Another important novelty is that in this last survey, it is possible to observe some of the findings looking at the different financial instruments used by the investors. This new way of asking questions and collecting data allowed us to come up with more relevant and accurate results. Some of these new graphs will be also presented today, and I'm looking forward to showing them to you. In terms of why EVPA conducts industry surveys since 2010, it is because we believe that it's important to collect data on BPSI practitioners and their activities. Indeed, the purpose of the report is to provide independent industry statistics and understand trends, which are crucial in a sector that is increasingly gaining importance and attention among a wide range of actors, including policymakers, traditional investors, and grant-making foundations. Furthermore, the analysis presented help existing investors and newcomers gain a broad understanding of the core activities and practices of venture philanthropy and social investment. And last but not least, since the VPSI sector is evolving rapidly, it is crucial in this specific moment to gather and aggregate data that are consistent with the definition and the boundaries of the space itself. This also helps investors for impact to better position themselves within the broader impact ecosystem. After having explained what that we at EVPA give to our industry survey, now I would like to listen to our speaker's perspective. So since you have always contributed to our survey, what do you think about this data collection and analysis? And why do you think it is important for your organization? So let's follow the alphabetical order. So Katinka, you can start, and then we will follow up with Elena, and then Franz, and finally Patrice. So Katinka, the floor is yours.
Thank you. Can you hear me now?
Yes, Katinka, we can hear you loud and clear.
Okay, yeah, thank you. To me, when we entered the EVPA, it was actually because we were interested in knowing more about the arena. And that was to know who's out there and how are they working, to learn from peers. And to us, it was very, very obvious that to get that knowledge, we also had to provide the knowledge to others on who we were and what we were doing. So I've found this yearly annual survey incredibly important to us, and always been interested to listen in on what's happening out there amongst our peers in Europe.
Thank you very much, Katinka, for your insights. I would like now to ask Yelena what's her opinion about this study.
Yes, so we've also contributed to the survey previously. I did it last year. It was my first time. I found it interesting to participate, and we will be continuing participating to actually see who the other investors are and the organizations behind impact investing. And I think importantly for us also to compare a bit what we have learned till now. So we started doing that a bit on our level with peer funds, and we want to do that more, and especially now as we are preparing in the future for fund number 2, it will be even more valuable, I think, to us.
Thank you very much, Yelena. Franz, now it's your turn. Can you share with us your perspective?
Yes, thank you. 3 points very briefly. One, I think the surveys that you're doing and the data you're collecting are extremely important, specifically for organizations who are engaged in the ecosystem building and in building the right environment. Because it draws together information, it provides information about the actors in the field, it provides information about the gaps and where we need to put in more efforts, or also shows achievements and positive trends. So I think from that point of view, extremely important. Secondly, I think it's very useful for as background and data information for lobbying activities, in terms of regulatory environments, in terms of policy making, either in individual countries or on the European Union level. And thirdly, a very direct effect for us as the foundation and as the largest shareholder of the largest retail bank in Central and Eastern Europe. We use the information that EVPA is providing, specifically through its service and its other studies, to engage with the bank in shaping a social banking or social finance policy and strategy of the bank, and we have found this extremely helpful in getting the information in the language that bankers understand to the responsible people in the bank.
Thank you very much, Franz. And now let's hear from Patrice.
Thank you, Gianluca. I can only echo the value for MDIF of being able to be learning from peers and seeing some form of benchmark. They're not exhaustive benchmark, but they're very useful to see some of the key messages that are triggered, which I hope we'll have a chance of discussing. But I think two things probably on top of this peer learning. The first one is that one of the reasons we've joined 15 years ago as a member was because we believe that in the space of responsible social impact investment or societal investment, Europe needed a voice. I think it needed a voice, and I think that not only EVPA that, but I think the survey is in a way feeds into creating a voice, a European voice on that subject as a capital tries to address a societal issue. The second one I can only highlight is that the market for the past 10 years has been evolving, morphing, and so forth into some form, some would say, some lack of clarity. And I think that one of the key things that struck me, that jumped at me during this survey, was the concept of trying to define in a lucid way the market into impact for investment, impact with investment. I'll come back to that in my comments, because for me this is becoming a sort of a key role that the survey is doing in EVPA in saying, well, these are all the actors in there. They fit together. They can coexist together, but this is how they fit. I will certainly be using this prism for my comments as we go down the rest of the survey.
So thank you so much, Patrice, and thank you, everyone. Thank you, Gianluca, for the introduction. And again, good afternoon, everyone. I'm Alistair Don, and as Gianluca mentioned earlier, I'm a EVPA research manager, and I'm responsible, together with Priscilla Boiardi and Gianluca, of course, for the data collection at EVPA. So now it's the moment to look in depth at the results and to engage our practitioners in a lively discussion. So I would like to start showing you the data that clearly describe our respondents first. And our respondents, we call them investors for impact, and it's important to start with the characteristics of these organizations in order to understand their activities and also to positioning them better in the broader impact ecosystem. So European investors for impact are grant makers and social investors that adopt the venture philanthropy approach, which is an high engagement and long-term approach to generating social impact while supporting social purpose organizations through 3 core practices. And as you can see here in the slide, these 3 core practices are tailored financing, organizational support, which is the non-financial support offered to investees, and impact measurement and management. We say that venture philanthropy is an high engagement approach since we are talking about an hands-on relationship between the social enterprise or the no-profit organization and the venture philanthropists and social investors. More than that, it's a long-term relationship since it aims to support a limited number of organizations for several years in order to provide the patient capital needed to develop innovative solutions. So let's focus now on the 3 core practices with the support of the data that we collected. So one way for VPS organizations, for European Investors for Impact, to be highly engaged is providing to social purpose organizations non-financial support alongside the financial investment. Non-financial support is crucial for social purpose organizations' development, especially when it comes to early stage ventures. And for Investors for Impact, the NFS, how we call non-financial support, is an essential part of the support given to the SPO, especially to strengthen their ability to achieve the impact expected, their organizational resilience, and also their financial sustainability. Hence, as you can see on the slide, almost every venture philanthropy and social investment organization reported to support their investees through non-financial support during the investment phase. So it's the 92% that you see on this slide. However, it is also important to highlight that over half of the VPSI organizations that responded to the survey provide non-financial support already before the actual investment, and a third of them continue to deliver it even after having exited the investment. So this really highlights the importance of non-financial support for the investees. So on the other slide, you can see what are the main non-financial support services provided by Investors for Impact to investees. So for example, these services can range from strategic advices to support in developing a theory of change or revenue strategies, or from help with human capital, human resources to advice concerning governance. And at this point, I would like to engage one of our practitioners today. So I would like to ask Elena a question specifically on non-financial support, since SHU Fund, so our organization, offers a wide variety of non-financial support, both before and during the investment. I would like to ask Elena to tell us more about all the non-financial support they provide. And also, I would like her to focus again on the importance of offering non-financial support to investees. And last but not least, maybe a mention to the importance of providing NFS not only during the investment, but also before the investment itself. So Elena, please, you can share your thoughts with us.
Okay, thank you. Yes, we offer all the support here that is in the graph, pre-investment, also post-investment. Maybe I tackle them one per point, and then I can share a bit what we do, what we focus on, also based on our lessons learned. On strategic support, I think we have come to one of our sort of intermediate conclusions, that it's all about the market development for our investees. If the market is not developed enough, and that is a lot broader than just the product, it might be too early for us in terms of our investment horizon, which is between 5 to 7 years. So maybe there's a mismatch there if a lot of work is needed to develop the market also. Linked to that is also the regional scope. If it's too limited, so it's difficult to go from one region in a country to spread it broader, then the economies of scale for us will also be difficult to reach. The third point here on strategic support is that we also assess, and I think all of the points we have to assess pre-investment as much as we can, is that business to consumer models tend to be difficult. So sometimes our investee companies will have moved to business and then business to consumer, or even business to government to consumer, for example. And that is something that is a shift, and it is better to assess that as much as you can pre-investment, or help them as much as you can to adjust during investment. On theory of change, it is important, obviously, SI2 has a social return on investment target, which is above 2. We'll come back on one of the questions, I think, later. What we found here is that we experience a lot of CEOs and companies that basically are obviously very convinced of a certain social problem or need. For us as investors, pre-investment, it is very important to distinguish a few elements. That a social problem does not always generate a need, then the need doesn't always generate certain user demand that you need in order to guarantee revenue. Now, all these 3 elements are very important to assess upfront if there is an actual payment ability and payment willingness on the side of the user. Yes, we'll come back probably also to that a bit later. On revenue strategy for us, we always require revenue, so it's one of our key conditions, otherwise propositions are screened out. However, not all revenues are recurring. And for our investee companies, being able to recur revenue is a very important element that we have to assess thoroughly pre-investment. Then again, the market, in terms of competition, sometimes we have seen that our market becomes hot in a certain sense and attracts a lot of competition. Sometimes that is very welcomed. On the other hand, it can also mean that some of the others have deeper pockets and it becomes very difficult then. So I think one of our key findings there is to reach out early enough to others and form some kind of strategic partnerships also with a view to exit opportunities and to actually benefit from the market growing. On human capital support, we have, when we come to the investment, also a lot of attention is given by the management of the fund, but also by the investment committee to assess the type of people that we have on board. Are they fit for the job, obviously? At the level of the CEO, managing director, it is very important that the fit is there, but also that there is some openness to coaching, because yeah, in most cases we are the first entrant, and it's going to be a partnership which is can be quite intense. So to assess if the CEO is open to that, if he can adapt, and also, that's a very difficult one, whether they're prepared to step aside when needed, which is also very important once the company starts growing. One element here to mention also that we are also now assessing upfront is you have certain companies that either come from a very non-profit model or are still grant funded and will either continue to be partially or are transforming into a fully for-profit company, and there you have to manage the people and the types very well, because sometimes there's not always the same definition of what success is, and then it takes a lot of time to change the culture. So we start with this: if we're interested enough and it makes sense to invest that time with a company, we start pre-investment with that. On governance, and this is linked to human capital also, and the point I mentioned about the openness of the management, and to be able to, when it gets also difficult, to not just have a shareholder-manager type of relationship, but to start building a board and non-executives being on it or independent advisors early enough, so you basically are able to form coalitions and probably be more effective in terms of governance, even though the company is small, so you don't want to overburden them with a lot of reporting and a lot of governance when it's still maybe not that necessary. It is important to think about it in advance before it is too late, let's say, to put it in that way. So building trust is our priority, but we also want to consider the power dynamics early enough.
Great. Thank you so much, Elena, for this interesting overview. So I think now we can move to the second core practice of the venture philanthropy approach, specifically tailored financing. Tailor financing, in the way in which the EVPA we describe it, is the process through which European investors for impact choose the most suitable financial instrument, including grants, debt, equity, and hybrid financial instruments, of course, to support investees. And this is a more and more common practice for venture philanthropy and social investment organizations, with almost half of the respondents always adapting their financing model to match their own goals with the needs of the SPOs, showing an increase of 14 percentage points compared to the past. Then, as you can see in the slide, almost a quarter of the respondents reported to often tailor their financing offer, while just a smaller share does adapt it in some cases rarely. So we believe this is a good result. But since we have the possibility today to listen to a real-life case of one of our practitioners, I would like to ask Katinka to share with us her insights about tailor financing, understanding how fair does it in practice. And I'm very curious to listen about one of the cases, that's one of the investment that's FAIR supported also thanks to a tailored financing approach. So Katinka, if you are connected and online, maybe you can share with us your expertise in terms of tailored financing. Thank you.
Thank you. And I think it's a broad arena, but we started out doing this investment in social entrepreneurs 10 years ago, and we've called it investment from the very start. But when we started, the market for social investments in Norway was almost non-existent. So we started out quite carefully, and we've been investing or working with 25 companies over these 10 years. But we quickly learned that when we entered into small, innovative social entrepreneurs, we couldn't go in there and buy parts of the company because they were so small and not mature as investment ready companies. So we all ended up doing grants very often, and also doing loans and guarantees. And quite early on, we met one of the most exciting companies, it was Unicus, and they had this idea that they wanted to do the same as the company Specialisterne was doing in Denmark, and that was doing IT testing and hire people with some autism spectrum challenges, with the Asperger's diagnosis. And we've seen and we've met with Specialisterne in Denmark, so we thought it would be a good idea to bring it to Norway. Kind of the same model, but in a more pure model, which was pure business, with people with Asperger's that have shown that they are better at IT testing than all us that do not have Asperger's. And we wanted to bring that into the market. The way we did that was to go out and find other possible investors. So we actually ended up doing grants from our side to get some private persons engaged in as the owner side of Unicus. So we took kind of a nice approach, and we let them go in with money and investment, but small though, because it was 3 persons hired in the company. So that was really early phase. And then we worked with them for 3 years, doing also kind of supportive investments along the road when they wanted and needed some help, working very actively with them as business developers. We sat on the board, so we kind of pretended that we had equity without having equity. It was an interesting role to play and new to us, and successfully worked with them for 3 years. They very quickly had a good income, and as a company has been growing ever since. But after 3 years, we defined that our period, or the period where they needed us, was through, and we could leave, and they went into our alumni part of social entrepreneurs. We of course had contact with them and helped them out with different occasions, but they've more or less been on their own until a couple of years ago, when we could see from the numbers that they stagnated in their growth, having reached about 20 employees with Asperger's. And we had a discussion with them, and it turned out that the owners was kind of risk averse, and we defined that we wanted to go in there as actually an equity owner this time, to give them the security to grow the company further. So now we're an investor and own 33% of the company, and that has given them the opportunity to safely go into 2 new places in Norway and also go to Sweden, and now planning an inclusion also of Finland as a market. And they have now about 52 employees. So it's been a phenomenal growth this last year. And this time we've been more like a professional investor, but also doing some, I would say, tailored business developing as well. But it's become a professional company. So it's been interesting to see ourselves in 2 different kind of positions towards the same company. That to us is a unique experience so far, but it has led to even more equity investments the last year. So we'll see where it ends up, but it's okay to now use all those different tools in the financial box that we have.
So thank you, Katinka, for this real life case. And I think I can take this occasion also to inform the audience that we are organizing as EVPA a training on specifically on tailor financing. It's financing for social impact actually, and Ferda was presenting last year, and it will be again with us this year, sharing real life cases in order to explain the attendees of the training how tailor financing really works in practice. So don't miss the opportunity to join us for the training as well. And of course, for more information on training, you can access everything you need on our website. So moving now to the 3rd practice of venture philanthropy approach, so impact measurement and management. We describe it at the EVPA, we refer to it as the collection of data linked to social impact achieved. And while talking about managing impact, we are talking about managing this data in order to take better informed decisions while investing. And of course, the final scope of that is to maximize and optimize the impact achieved. So European investors for impact seem to have improved their impact measurement and management systems. As you can see in the slide, the share of organizations that reported to measure outputs, outcomes, and impact increased compared to the past. Particularly positive is that the share of VPS organizations measuring outcomes reached a record high 92%. However, looking at the results, and again, as you can see in the slide, we believe that the increase in the share of the respondents that measure impact per se, so the 3rd column on the screen, probably comes from a lack of in-depth understanding around the real meaning of measuring impact in academic terms. But since today we have the chance to address these questions and these issues to practitioners, I would like again Jelena now on stage, because I would like to hear from her what is her insights and the insights of SI2 Fund on impact measurement and management, and also I would like her to elaborate further on the main challenges and the lessons learned linked to this important practice. So Jelena, the floor is yours.
Okay, thank you. Yeah, so SI2 Fund uses social return on investment method by Social Value International for all of our companies. we till now, for several reasons, also focused more on outcomes, as we are gradually growing into full impact measurements for all our investee companies. It's early stage investing, so the companies are small. There's a lot to deal with in the beginning. So while we have assessments, pre-investments to assess whether we can reach the target of 2, a full impact measurement system and to implement that, none of our investing companies have that yet, but it is the goal we are currently working to. What are the challenges there? Obviously, the management has impact in the DNA, but to basically spend the resources, money, people, time into also measuring it, it needs a lot of convincing and also trust in that it will actually be of benefit for them, we find in practice. Some of the elements of increased accountability, increased opportunity to attract talented people to your company, being able to attract future funding for your company, it's all easier if you're able to communicate more about the impact. But it's a discussion that we are having for each of our companies on an ongoing basis. What we also found on our fund side is that how can we help them more? How can we address this better and see if, for example, maybe there's something we can do. We started a partnership with SOPACT last year, which is a social impacting consulting services company. They will provide us with software as a service platform, which I call Impact Cloud, and that will give each of our portfolio companies access to the platform, and they are able to then only run the relevant applications for them and import manage their data. It will track for us for each of the ventures the data. We can aggregate it. We can make impact maps, and it's a user-friendly interface for our investees and also for us being able to report on fund level to our shareholders as well. As said, we've started last year, so our goal is now out of 5 investee companies to have our first one on it by mid of next month, and then to gradually have the other ones follow.
Thank you, Elena, and I'm sure we will be in contact with you to learn more about it, the next phases. So, yeah, so maybe we can move now to the next slide. So after having explored the 3 core practices, we can say now something about one of the major characteristics of the VP approach adopted by Investors for Impact, meaning the long duration of commitment, as I was mentioning earlier. So thanks to the novelty introduced in our surveys, Gianluca explained during his introduction, we can observe that the duration of commitment of VPS organizations varies depending on the financial instrument used. So for example, the financial resources deployed through grants have a shorter duration, whereas the resources deployed through debt and equity are more patient. So as we can observe from the slide, half of the grant makers support grantees from 2 to 4 years, while equity is confirmed as the most patient form of capital within the VPSI space, with 91% of respondents using this financial instrument to support SPOs for more than 4 years. So confirming again that the VP approach tends to be a long-term approach. So now I would like to ask Franz Karl from Erste Foundation his perspective on the different financial instruments, and since Erste Foundation provides not just grants but also other financial instruments, I'm particularly interested in understanding the perspective of this organization, also maybe referring to the use of the different instruments with the link also to the duration of commitment. So Franz, if you can share with us more insights from Erste, it would be great.
Yes, I think I'd like to say first that we started out as a foundation about 14 years ago, basically as a grant-giving foundation. We had no plan or scheme or strategy to go into other forms of funding, financial support. But in that respect, we were a very sort of run-of-the-mill foundation. However, I think very quickly in the course of our growth into the strategy that we had set ourselves, supporting a vibrant, strong civil society in Central Eastern Europe in various aspects, I think we realized that we needed to adapt our funding and our financial support. We still do the large amount in terms of grant giving. Now, if I look at grant giving in terms of a more impact-oriented grant giving with a view to social enterprises, social entrepreneurship development, our grants generally cover periods of up to 3 or 4 years, because they are meant to provide young startups, social entrepreneurs with the means to become investable. So that's the first steps. We go with them. We accompany them quite intensely in that. We have a number of non-financial support systems in terms of organizational development, training, leadership training, financial literacy, etc., that we then provide as well. But I think we have the possibility as a banking foundation to also work closely with the bank, and this is, I think, our strength in a way, because we can connect with the bank, we can connect our grantees into programs that then are picked up by financial services that the bank can provide. And our aim, in particular the social enterprise development, is that we can bring social entrepreneurs into a stage where they then can, for example, continue with debt financing from the bank. And again, here, the debt financing is in a way a cooperation between bank and foundation, because we have established for certain types of social enterprise debt financing a guarantee scheme that enables the bank to provide these finances with a lower risk costs to the customer, and also to do that within the rather strict regulatory environment that, of course, now is in place. The duration there generally varies between 3 and 5 years for the smaller entrepreneurs. We have a microfinance vehicle that we established, and now I come with that to the third form of providing funding, and that is equity. We did invest in somewhat larger and more important enterprises in terms of providing equity for them. However, this was done as part of our own strategy in terms of creating local vehicles, financial inclusion vehicles, that then could continue working with small entrepreneurs, social entrepreneurs, but also people in poorer sections of society or geographical areas, in, for example, Romania, in terms of providing microfinances. Here, our investment is long-term. We have actually no real exit scenario, because these instruments are created together as a co-investment with our bank to provide long-term social inclusion, financial inclusion services for people who would otherwise not be able to access this type of service. And here the equity is quite large in terms of several million euros that we provided for that. but it was part of building the infrastructure to be able to provide this financial inclusion services. Debt equity by the foundation itself is for us relatively rare. We only really have one case, and that was the case of the first social impact bond in Austria, where we provided a loan to the intermediary organization that set up the social impact bond, and we are just in the process of writing this off because the social impact bond did not result in the impact that it was supposed to have. So this is another lesson learned for us, and it's a measure or a means that we are not going to provide too often, and we are not quite decided yet whether we are going to do that again. However, the form of a social of a debt financing was the proper form for that. This was a 3-year investment, and as I said, it didn't really have the results, the success that it was supposed to have. I think overall, in terms of lessons learned, for us, the question is really how do we structure our financing and how do we adapt it. We learned, or we adopted a very flexible approach, situational, partner-oriented, so that we can provide whatever is needed at the particular moment in the particular situation for a particular purpose. So I think we are a very flexible organization in that. We like to stay very close to our grantees or to our to the entities we invest in. For example, the entities where we provided equity together with the bank, we are always in the board, in the supervisory board. We control these organizations. We follow very closely their development. Of course, it is part of the implementation of our overall strategy, of course. Yeah, I think that's so far for that, and I'll be able to answer questions later on.
Thank you so much, Franz, for sharing with us your experience and also for having touched a bit the collaboration among the foundation and also the bank. I think it's really interesting, and we will have some discussions also afterwards with some of the other panelists. So moving to the next slide, a very lively debate happening in the impact ecosystem nowadays is around financial returns expectations. So we are happy to contribute to the discussion also using the data we collect. So moreover, this year, for the first time, we can report on the diverse financial returns expected depending on the financial instruments used, giving a more accurate picture of the VPSI sector. So let's look in depth at the results. You can see on the slide that the large majority of VPSI practitioners deploying debt, financial returns expectations ranging from 0% to 5%, and we can observe it in 77% of the cases. And with these, among these organizations with these expectations, half of them just seek a capital repayment while using debt, whereas more than half of the organizations investing through equity target financial positive returns over 5%. Anyway, it's good to mention that the 80% of the respondents still have positive financial return expectations not exceeding 10%, and I think it's important to highlight these results. And then on the slide you also have the results linked to hybrid financial instruments, and as you can see, 2/5 of the VPSI organizations employing them are using them to recover the capital invested. So most probably deploying recoverable grants, which in our understanding and in our vision are hybrid financial instruments. while the rest of the return expectations reported are comparable to the ones of loans and equity that we just mentioned. So summarizing, if we look at the averages, we see that while that users target on average a 3% of financial return, equity investments target on average 7%. But since we have the chance again to have our practitioners connected with us today, and since again this debate around financial returns in our space is really a lively debate, I would like to ask Patrice, thanks to his experience in managing an impact investment fund, to share with us his thoughts around expectations and financial returns possibly achieved in the space. So Patrice, the floor is yours.
Thank you, Alicia. I think you're absolutely right. The financial returns expected is one of the hottest debate right now in our sector. And as I try to give some perspective that might be useful for the audience, it's always interesting to do a webinar because you don't have the body language and the interest and so forth. But so I thought what I would do is probably try to look at it from our point of view, from our vantage point of view. What do these numbers on that slide mean for us, in the hopes that perhaps that might be of interest. To do that, I need to say one-liner about what we do. So if you use the framework that Gianluca was using at the beginning from Venture Philanthropy Social Investment Fund, that's what we are. And we invest in what's called SPO, Social Purpose Organization. In our case, those are independent media company in countries where there's a history of media oppression, meaning that our societal value we've seen is in providing quality and fact-driven conversation in these countries. You can imagine that the world in which we live right now, this is not just touching emerging markets where we operate, but also in the world. We've distributed $171 million over 23 years, given back 46 million to investors in the form of the instruments that you have on the slides right now. I'll come back to that in a second. And we measure extensively our impact for the past 10 years. One of the key indicators is we have the SPO, the Social Purpose Organization, which we funded with these $171 million. They now reach out to 93.7 million people. These people get the information, the quality information from the Social Purpose Organization, these independent media company we fund. Now, as I said earlier at the beginning that for us, as a venture philanthropist fund for 23 years, it's interesting for us to start to see, and I commend EVPA for having found I think a beginning of a framework that says, well, actually there are people who invest for impact, and I'll come back to that, and there are people who invest with impact. Investor for impact, they see themselves as they start from the social challenge they want to solve. The beneficiaries, the recipient of the funding, the financing are at the center. For them, financial and non-financial supports are equal. They are indispensable instruments to go together to reach the impact. This is clearly where we stand as we look at these numbers. We believe that the starting point is how can we increase financing, impact financing to the societal value, the social cohesion of information that we need to function every day. That's critical. The other type of investor in the framework, which I really like, is investors with impact. They are just as important, but they are really primarily investors. The impact aspect is considered alongside the need to achieve financial returns. I believe there is, as I said earlier in my intro, there's a need for the coexistence of these two things, and I think it's important that there is a European voice that these two things exist. Now, going back to, we believe we are an investor for impact. Societal challenges are at the center of what we do. As we look at these numbers, well, we've in terms of debt, we provide 4%. So that's what we've managed to provide to the people who fund us. Now, we ask from our funders, for the people we invest, we expect a return of about 5.5. I can explain in the questionnaires how do we match the delta between 4% we give to investors and 5.5. In terms of equity, I'm happy to report that we've launched the first impact private equity fund for independent media. It's a 30 million fund aspiration, and what we will be proposing is a 10%, which seems to be a little bit above the average, which Alicia mentioned of 7%, but that's pretty much where we are now. I want to cap this sort of the way we look at these numbers, as I said earlier, what is our vantage point of view, by a form of lucidity. I think that our 10.5% aspiration for the private equity fund we've created is based on a track record which is double that. So we've tried to tone it down quite massively from above 20% to promising now 10.5% on a off-balance sheet private equity fund for impact media. Now, it's going to be, we've started this 2 years ago. We're 2 years into it. If you look at the valuation inside that fund, we're on track, but we don't know where that will go. Many things may play an actor. The point I'm trying to make is that it's important that two things are important. The first thing is that a lot of the space of VPSI, of venture philanthropy and social investment, is coming at 10 years mark now. So that means that there are going to be equity funds or equity ventures that will have been created 10 years ago. And as some of you may know, the usual timeline is 10. It could be 10 plus 2 years and so forth. That means that in the next few years, probably this year, next years, we're going to see the results of using equity in terms of the result. And because what we have in front of you in this slide is really the aspiration, but what's going to happen. And I think I'm curious to see what that will do. My sense tells me that I'm not sure we will be able to meet these aspirations. I hope we'll be able to do that. So that's very important. The second thing, and I'll end with that, is I think that the prism of looking at investing for impact and investing with impact is critical here, because I think that there are societal challenges that we're going to try to solve using capital in the next 10 to 20 years that won't be able to supply the same expectation for investors that invest with impact, meaning that the impact aspect. I think that will be needed. There are still societal challenges that can be solved with market returns, but we should not forget that there will be massive societal challenge that will, I mean, that's the whole point of the innovation of the venture philanthropy and social investment world, is to be able to do that. So I think that my lasting point is to look at these figures, first that they are aspirational, but also to keep an eye of what is it we're trying to do. And if we're trying to do societal challenge, if the aspirations are above what the results are, I don't think we should be we shouldn't be throwing with the gauntlet, or we throwing in the towel that say, well, it doesn't work. This is a process in motion. Thank you.
Thank you so much, Patrice, and indeed thank you also for mentioning the effort that EVPA is doing in clear the air a bit around these expectations and trying to really identify the characteristics of investors for and investor with impact. We will come to this later with a slide at the end of the webinar. So now let's move to the overview of the venture philanthropy and social investment sectors as described by the data we collected last year. So please, Gianluca, go ahead.
Thanks, Alessia. So one of the most relevant questions we asked our respondents was how much they invested or allocated in the last fiscal year. The answer we got is that on average they invested 7.8 million euros, which is in line with the amount invested by the respondents in the two previous surveys. However, when looking at the organization that responded to the survey both in 2016 and 2018, what we call the sample, the average investment per VPSI organization increased of 13%, as you can see from the slide. But I would now like to focus on the geography. So where do European venture philanthropy and social investment organizations invest their money? As you can see from the slide, worldwide. However, Western Europe remains the main target region, receiving 54% of the total resources invested. It is interesting to see how, within Western Europe, only 3% of the total investment was made cross-border, probably highlighting a need for better conditions to facilitate cross-border investment. The last results tell us that Asia registered the largest increase compared to the past, attracting now 14% of the resources deployed, while Africa remained the second target region, receiving 16% of the funding. Another interesting trend is the growth registered in Central Eastern Europe, with 7% of the resources allocated there, compared to the 2% of 2 years ago. This result is likely to reflect the increased number of organizations coming from this region and investing locally, also thanks to the work that EVPA is carrying out in this region since 2014. So I would like here to ask Franz, since Erste Foundation has always been active in this region, to share a bit with us what is his perspective on this growth, and also to elaborate and explain us a bit on the VPSI market characteristics in this world region, so in Central Eastern Europe. Franz, the floor is yours.
Thank you. I think we are seeing several characteristic developments which are unique to the region. One, of course, is that this is within Europe still the fastest growing region in terms of economic growth. Most of the countries of that region are exceeding in their economic growth all other Western European and European Eurozone countries. That also means, as this was a relatively unbroken development for the last 35 years or so, that in the last 35 years you have had a significant wealth buildup. Several people who built up businesses, brought them to the stock market in the last years, cashed in huge amounts of money in certain cases, are now looking for investing that money in a more socially relevant and effective way. We also see a very lively and vibrant young social entrepreneurship scene, mainly focused or gathered, clustered around the impact hubs that have been established in the last 10, 15 years in the region, and that are really hotbeds for interesting, creative, innovative social enterprises that are popping up now in the region. So we see a lot of small startups that are happening, small startups that do need small tickets in terms of either equity or debt financing, small startups that very often depend on grant giving in their very first stages, or on the famous 3 Fs, the friends, the families, and the fools, to finance them. They are in their longer term effectiveness not yet really proven. So it's a rather volatile situation. I think that we see a lot of interesting ideas popping up. I don't think that we can see yet a lot of very durable, longer-term social enterprises springing up or developing, partly due to also the issue of the value of death in the financing in the later stages. But I think we'll come to that also later. The other problem is that we still have not a very well-developed regulatory or legal framework in most of the countries of Central Eastern Europe for social entrepreneurs, social businesses, and social impact investment. Increasingly, we do see, as I said in the beginning, the setting up of investment funds. In Poland has been very much in the forefront of that, but also now other countries are following suit. Hungary, even in Bosnia, the Mosaic Foundation that has set up a small investment fund there as well now. So this is definitely part of the increase we see, but I would say that most of the increase we saw in the last 2-3 years is actually locally sourced increase. It's not money that is flowing into the region from outside, but quite a lot of money that is generated locally. because of still strong economic development, and increasingly people who have now money at their hands and are looking for this investment. That is certainly driving this environment. I don't know, Gianluca, if that's answer enough, or if you would like me to elaborate a bit further. I mean, one other thing I could probably say is that, of course, there are some larger players particularly in the social service field in the region, mainly some of the faith-based organizations like the Catholic Caritas or the Orthodox Church organizations, Protestant church organizations. There, the financing happens basically via debt financing from the established banks. There's not that much funding, I think, in terms of recoverable funding, either debt or equity, from foundations or other investment bodies. That's rather more either it's donations or they have good relations with the banks or for their larger social programs.
Thank you very much, Franz. I think, this was a very good and precise overview of the Central Eastern Europe venture philanthropy and social investment markets and sectors. So thank you very much. I would like now to move on and look at the solutions that VPSI organizations invest in. So European Investors for Impact support a wide range of sectors, from education to social services, from environment to health and culture. However, in the last fiscal year, economic and social development and financial inclusion were the two top sectors that attracted together more than half of the total investment reported. As the large majority of the VPSI organization indicated to support multiple sectors, we can see that European Investors for Impact are increasingly becoming sector agnostic, looking for opportunities to invest in innovative ventures, regardless of the sector in which these social purpose organizations are active. Regarding this specific topic, I would like now to ask Katinka to comment a bit on explaining us first social entrepreneurs' approach towards social sectors, and if and how this evolved in the last few years. So Katinka, please, the floor is yours.
Thank you. Well, when we started out 10 years ago, we had a drive towards empowering children and youngsters. And as we matured and we met with social entrepreneurs, we felt that to provide social results in Norway, being a very small market, to do that effectively, it started to feel a bit short-sighted to only look at children and youngsters. And I have to put in that we also target social entrepreneurs that have business viable ideas, so that we need them to have a double bottom line and to create their own income, at least during some years, so that the whole company gets viable and can sustain themselves without any supporters like us. And that means that we need to find those who are good at creating that double bottom line, and maybe look outside of the children and youngsters space to see whether there are other areas where you can find even better social effects for our money in creating those kind of social entrepreneurs. So we've broadened the space, and we've kind of looked at people being youngsters when they enter into the job market. How long can you be a youngster? And we just felt that we were constantly pushing the boundaries. So we decided a couple of years ago that we would leave the children and youngsters space and go into a discussion more based on how much social effect will the different possible investments do or make. So we've actually also put in a lot of effort, both hours and money, into creating a market for social entrepreneurs in Norway. So it's been kind of indirect investments as well, to help out all social entrepreneurs in Norway to easier access a market very much to the welfare state, which is quite developed in the Nordics, so that they could more easily be picked up by customers on the governmental side and also on the municipality side in Norway, which is quite a new arena, actually, as you've heard from the other speakers as well. It's happened a lot these last 10 years, and it's still a bit immature, but it's growing. How you can involve innovative social entrepreneurs into building a welfare in European welfare state style. So we've kind of now said that going from a total open space, we have set a target as being investing in inclusion as a social effect, which is of course a quite broad term, which means you can both have children and youngsters, but you can also have ideas where you can combine, so you get elderly people included into society more, and also people like the ones with Asperger, different kind of challenges. So yeah, you find that we have now a much broader spectrum of social entrepreneurs based on good, viable business models, but also based on what kind of social potential we see in the different investments.
Thank you very much, Katinka, for having shared your insights and your learning on the sectors. I would like now to move on and talk about the type of SPO supported. So looking at the sources of capital attracted by different type of SPOs, as you can see on the slide, we can observe that non-profit organizations without trading revenues almost entirely depend on grants. While moving towards more for-profit entities, we see other types of financial instruments, such as debt and equity, which imply the ability of the SPO to repay the investment. Now, on this specific graph, I would like to explore how EVPSI organizations choose between different financial instruments to support the same type of SPO. On this regard, I would like Patrice to share his view on this topic, explaining us which are the criteria used to select among the different financial instruments available for funding the same type of SPO. Please, Patrice, the floor is yours.
Thank you. I will be brief on this one. Again, in line with what I said earlier, if I look at this slide from the vantage point I described earlier, I see the following key message. One, the variety of the instrument based on the type of social purpose organization you're funding is very varied, and that corresponds exactly to our experience. One, we have a very high-level process, 7 steps that are actually different whether you're using debt or equity. We don't use grants, or we don't fund nonprofit. We also use hybrid. So point 1, very varied. Second, it varies not only in terms of SPO, but also based on the vehicle. So there's a matrix there. So if I were someone attending this webinar and listening in, I think that is a critical component of venture philanthropy. The second one is when do we, a very headline on when we use equity and when we use debt. In our case, for the social case we described, we'll use equity in 2 cases, more than 2 cases, but there are 2 critical cases when there's a foreign exchange issue. That's very important for us because of the countries where we work, I've described earlier. And the other reason is because of the sector we are going, media. There is a lot of changes in terms of growth capital needed, and in that case, equity. In the case of debt, we look very closely. We will use debt if there's a cash flow, if there's a positive cash flow possible of being used, but we will do that in a very tailored way, and we will be providing much more hand-holding in the case of usage of debt than we would in the case of equity. Thank you.
Thank you very much, Patrice, for the brief and clear response to the question. Thank you very much. As we are running a bit out of time, so I will now move on and focus on the key trends that we have identified in our study. I would like to start talking about the budget. So the first trend identified shows that the majority of European VPSI organizations are increasing their budget size. As shown in the slide, the share of organizations allocating more than 10 million euros to venture philanthropy and social investment activities has increased from the past. However, in line with the past, almost half of the respondents still indicate a budget smaller than 2.5 million euros. Again, I would like to engage with Patrice and ask him to share his view on this topic, bringing in his social investment fund perspective. So, Patrice, do you observe this trend of growing budgets specifically within the VPSI funds landscape?
I think we go back to this prism again of impact for investing for impact and investing with impact. And I think what reassures me, the way I look at this slide, is the fact that there will be a need for operational budget to increase. This reminds me of an interesting phenomenon that happened about perhaps 10 years ago in the foundation world, and perhaps Frans Kahl can confirm that. I remember a speech by a gentleman I have a lot of respect in Europe called Rien van Gent, who said in front of the foundation world, saying, we have got to move from only project-driven funding, but also to look at the operating expense of the grant, the people we support with grants, not just funding grants. I think that this slide is a seminal moment for our industry to also say that if you are inside that dichotomy of investing for impact, if you start from the social challenge you're trying to do, if you believe that financial and non-financial supports are both equal, there will be a different approach than to look at it from just, is the management fee paying for the OPEX? And I think that's one key message. The second one is a very concrete example that happened to us. When we launched the equity fund I launched earlier, the type of investor, the anchor investors we attracted, we proposed a 2.5 management fee on this impact private equity fund. The anchor investor turned back to us and says, sorry, that's not going to be a lot. That's not going to be enough for you. We've made the number. You should put it up at 2.75. Another signal that this sector of venture philanthropy and social investor has a different prism as looking at things. It's not about minimizing the management fee, but making sure that if you are investing for impact, the organization you are funding, in this case us, the venture philanthropy fund, has enough to support that. So that's the key message that I get from this slide.
And thank you very much again, Patrice, for another very insightful comment. I will now move on the next slide and focusing now on co-investment. The second trend we identified is the increase in co-investment. About 70% of respondents had co-invested in the past, and 14% said they were interested to do so. So in the slide here, we can see the different type of co-investors. And I would like to engage now with Jelena, since we know that SI2 fund usually co-invests with different type of factors. And I would like her to share with us a bit her insights on co-investment, focusing on the key learnings of engaging with different types of co-investors. So please, Jelena, the floor is yours.
One like-minded investors in order to share resources and the burden of knowledge networks of the investment. Till now, we found that basically there are other foundations or angels or others already there, and then it seems in practice for us to be quite difficult to find at the time of our investment exactly one other. And for us, it would be category 2 and probably 3 and 4, venture philanthropy, social impact investor, venture capital, or finance first impact investors that are aligned at the same time and willing to, at the same moment, to basically go in. I think one of our key findings here is that we will start reaching out to our like-minded investors a lot earlier. We will start building those relationships so they are stronger. This is what we have been doing and want to continue to do more. We considered also propositions that we didn't before, being part of a consortium. So we will be of less influence in the sense of our share, but still can play a significant role, let's say, in our geographies where we are active. And in that way also probably contribute, let's say, to delivering the impact more than we did before. I also wanted to say, and maybe I conclude here because of time, about the public finance institutions, either being a funder or being a customer, for us is, and maybe it links also because my home market is the Netherlands, also where I guess the social welfare system is quite developed. It is sometimes difficult, but also interesting if the company has that hybrid model where also governments are part in contracts, winning large contracts. For them to scale, it is sometimes very difficult because governments, they obviously focus on the impact, they are less about the revenue and the financial sustainability of our companies, and they are also less predictable, we found. So it is quite a risk, and one that we are, willing to share knowledge and maybe lessons learned with others to see how we can move forward with that. Maybe I'll leave it with that for here now.
Thank you, Yelena, for your comment on co-investment and the different type of co-investors. I would like to move on to the next trend, which we have found in our study. Another very interesting result, as I was saying, is that VPSI organizations provide financial resources to fill the SPO's financing gap, helping investees to get through the valley of death. Indeed, the average investment size per SPO for half of the respondents lies in an interval that goes from less than 5,000 euros to 200,000 euros. This finding is encouraging, as lots of experts in the field, the European Commission included, acknowledge a lack of funding for SPOs needing tickets of this size range. I would like Franz to explain his organization's strategy in terms of average amount provided to each investee. Has your approach changed throughout the years, and what's your perspective on this issue of the value of death?
Sorry, Gianluca, I didn't understand, I didn't hear you now for the question. Could you just repeat the question? I think you were off.
Yeah, sure. Sure, Franz. So I asked you to explain us your organization's strategy in terms of average amount provided to each investee. And I wonder whether you can tell us whether your approach has changed throughout the years, and what's your perspective on this issue of the value of death?
Well,
have you heard the question now?
Yes, I mean, I've heard it. We've been very active on this. I think we are quite acutely aware that this is sort of the region of tickets between 50,000 and 200,000 euros. That is for young social enterprises, but generally also for any type of startup, difficult to come by, particularly in terms of debt funding. And here I think we, as a foundation, we have provided grant money to help social entrepreneurs that we have been supporting all along get over that to an extent. It's short-term grants and relatively small grants, but just to provide backstopping mechanisms so that they can move on. However, this is something that we relatively rarely do, because we believe that as they've already had proof of concept, as they've had their first steps as businesses, it's rather that they should be supported by the proper financial institutions, either investment funds or banks that are tailored for that, and that have and can develop mechanisms for that. I think one of the difficult issues is that for an investment fund to provide small tickets, it's economically not really viable, because the costs, transfer costs, are basically the same whether you give a 2 million investment or you provide 150,000 euros. So the European Union has done something interesting in providing support for these transfer costs, and this is, I think, an interesting and helpful step that they have considered. Also, I think the particular establishment of smaller investment funds that target this type of investments, the size of investments, has grown, especially in Central Eastern Europe, where this is a particular problem. I think there has been a response from that field. And also we, together with the bank, have developed instruments or vehicles that would help in that. For example, guarantee schemes, where we, together with other either public bodies or foundations, also the European Investment Bank is part of that in many ways, are providing guarantees to the bank in order to finance businesses, social businesses, through this valley of death. I think, however, that sustained lobbying also with the European Union, and particularly now within the InvestEU program, are necessary and are possible actually now for sustaining these efforts in terms of providing either direct transfer support or tailored guarantee schemes that would help established financial institutes like banks to provide the necessary funding through this valley of death.
Thank you very much, Franz. And now I would like to present you the last trend, which regard the pipeline management. So as you can observe from the slide, the PSI organizations diminished on average the amount of investment screened and on which they performed due diligence, while the final number of funded investees increased. As presented in the report, these three results combined show that European investors for impact have improved their pipeline management, better selecting the investees to perform due diligence on. I would like to ask Katinka to share with us some insights on how First Social Entrepreneurs screens and selects its investees. Katinka, the floor is yours.
Thank you. When we started out, we didn't know how to find the social entrepreneurs, and in this Norwegian market, we spent some time building up the awareness amongst social entrepreneurs that there existed an investor in their market. And more or less from that time on, we've had no trouble with the influx of interested social entrepreneurs and companies wanting to enter into our investment scheme. So it's been around 200 applicants a year into our system. We set up a database where we handled them, and we've tried to select them quite strongly on the criteria, so that we've been working with them for a time, and before we go into the selection process for which one should come to a more close lookup, which means that we would have, first they will come into our database, or they will send us a mail presenting themselves. We would then pick out the ones who's fitting into our criteria and ask them to elaborate, very often by mail, because the pressure on our time is quite big. And they will then come back and explain us, and very often it's around the business model. And then when we find out that they still fit our criteria, we will invite them for a meeting. And the next phase from that meeting, if they still fit the criteria, is very often a quite not so formal process in our case, because they are small companies, very often 1 or 2, 3 persons. We would like and we've learned that we need to get to know them as entrepreneurs. So we have a close dialogue with them about the company. And if we, during some months back and forth, getting to know them, still feels that this is a team that we can rely on, this is a concept that we really like, then we go into a presentation where we present them, and very often also a couple of different cases, to our board, and ask whether we should go into the due deal process. And then they will be selected for a due deal, which means they are potentially into our investment phase. And then we'll have a due deal, and very often we find that it's very few of them who will actually be declined because of the due deal, because we've got to know them quite well during some months. But it happens, but very, very rarely. And then we'll pick out the company, present the due deal results, what we want to get out of them, and what kind of social potential they have. And we'll present it to the board to get a final approval. And then we'll be investing for 1 year, which we did after having had trouble with some companies for the first 4 years, because we saw that we wasn't really getting to know them until we started investing and started business developing together with them. So we have what we call grundtrim, which is kind of a first step approach with 1 year of financing. And after that 1 year, we have another round where we have to go once more to the board and present what they have achieved during that year and what we think they will be capable of doing over a new period for 3 years with a longer time investment and even more closely follow up by us and a further investment. So then they will get more time and more money those 2 years because we now kind of chosen each other. And it's important that they also have the chance to choose us or not choose us after 1 year of practicing with ourselves being in the board and being business developing with them. So it's quite a demanding process.
Yeah, thank you so much, Katinka, also for highlighting this last challenge. So thank you so much to all our experts today. Thank you so much, Gianluca, for the overview and the trends identified. So we have come to the end of the webinar. In case you have additional questions, in case you didn't receive an immediate answer to your question through the question section through GoToWebinar, you can always write us an email. You can see, then we will share with you our contacts. And just to again come back to the impact strategies journey of EVPA. So as also Patrice mentioned several times, this identification of investors for and investors with impact, I would like to share with you the link that you can access actually to learn more about what we are doing in terms of impact strategies journey. And we are really looking forward to listen to your feedback, actually to receive your inputs on that. So you can access the link EVPA Impact Strategies Journey, and you will see information and also a form in which you can contribute to this lively debate. And at the end of this webinar, you will have a survey, short survey popping up on your screen. So since we are also interested in the impact that our activities have, it would be really great to understand your feedback, your feeling around this webinar and the topic. And as Gianluca was mentioning at the beginning, as of next year, you can find the recording and the presentation of this webinar on our website. together with all the recordings and the slides of our previous webinars, including the one on policy. And precisely, there is also a webinar on InvestU that is a topic linked to policy that also Franz mentioned earlier. And then a special reminder for all of you that are also EVPA members, you should have received in your email a proper membership satisfaction survey, and it would be great again to listen at your feedback, to receive your inputs in order to help us shape our way forward. So I think that I can really close the webinar now. Again, thanking Gianluca, Priscilla, and all the Knowledge Center colleagues, our experts, panelists. So have a good afternoon, and don't hesitate to stay tuned. Bye-bye.